Okay. Okay, so this mock exercise deals with consolidation subsequent to the acquisition date. And we're going to take a look at a question where large purchased 75% of small. And this happened on January 1st, year one, and they paid $600,000 when the statement for financial position showed that they had common shares of $400,000 and retained earnings of $100,000. So that's the date of acquisition, and that's going to be a very important information for us to track to make sure that that's our starting point at the date of acquisition. That's the shareholders' equity of small at the date of acquisition. On that date, inventory of small was undervalued by $40,000, and a patent with an estimated remaining life of 5 years was overvalued by $70,000. Small provided the following profits and dividends for year 1, 2, and 3. And you can see that Small had a profit of $80,000, dividends of $25,000. But the second year they had a loss of $35,000, but they also were able to still issue and declare dividends of $10,000. And in year 3, they rebounced back and they made $90,000 profit with a dividend of $40,000. A test for goodwill impairment on December 31st, year 3, indicated a loss of $19,300 being recorded for year 3 consolidation. So what we're asked to do is Part A asks us to prepare the journal entries using the cost method, and Part B asks us to provide what would the consolidated financial statement values would be for selective items on the balance sheet. And then Part C asked us to what would our journal entries look like had they used the equity method to record the investment. So let's get started. So whenever there's an acquisition, we always need to analyze the acquisition differential. So we need to analyze that the cost at 75% investment, so this is how much we paid, was $600,000. And because we're using the acquisition method under IFRS, we need to value 100% of the company, and to do that, we need to calculate the implied value. And the implied value is calculated by doing an extrapolation of the values that we paid for 100% of the investment. So in this case, we would take 600,000 divided by 75%, and that would effectively give us 100% of the fair value of small, and that is 800,000. Now, we're going to take that 800,000, we're going to compare the 800,000 to Small's book value, or I guess it's net book value, would be common shares, so I'll short form that as CS. That's 400,000. And retained earnings is 100,000. So the book value at the date of acquisition, so the date of acquisition, right? Is 500,000. So that means that we have an acquisition differential of 300,000. Now, we need to allocate this acquisition differential to any fair value increments. We're going to spell that FVI, fair value increments. And we're told that inventory was undervalued by 40, So we know that we need to debit this inventory. Why? Because Small probably recorded the inventory at 40. They probably did some lower cost of NRV at some point. But now we're looking at the fair value of those inventory, and it's actually higher. Patent, on the other hand, has been overvalued, so we need to credit the patent. So giving us a net acquisition differential of $30,000. So that's a net credit, isn't it? Now, that helps us analyze so that we can determine the goodwill value. So the goodwill is $330,000. Okay, so we know that this is a debit, and we know that this is the acquisition differential. We paid $300,000 more. Part of the reason why we paid more was because inventory was obviously undervalued, but patent was overvalued. So in essence, we need to add those two to get to a goodwill of $300,000. Couple things to always note: that we know that inventory is assumed to have been sold under the FIFO basis. So we're going to assume that this is FIFO, which means that it would have been sold in the current year, right? Sold in current year. That's an assumption we're going to make. And patent, because the asset has a useful life of 5 years, we're going to amortize that over 5 years. And we're going to see that in a minute. Okay. Now, we're going to actually do what we call the amortization schedule. And it's imperative that we do this because a lot of the information that we're going to take from this amortization schedule is what we're going to need to calculate some of these consolidated balances. So we're going to list the total. So this is called the amortization schedule. Okay, so let me highlight that. And we're going to start with the beginning balance. And that would be 1/1, year 1, which is the date of acquisition. Now, we're asked specifically for year 3. So that means that we're going to perhaps accumulate the year 1, year 2 amortization. I just think it's much easier and less room for mistake if we're focusing on year 3. We're going to keep that as a separate column in our amortization schedule. And what we're going to do is we're going to accumulate the amortization for the past years since acquisition. That's essentially what this is. So if the question was asking us for year 8, for example, this would be year 1 to 7, and this would be year 8. Because that's the year that we're focusing. That's the year that the question is asking us to provide a consolidated statement. And this is the ending balance as of December 31st, year 3. So we've got inventory, and the balance of inventory is $400,000 or $40,000. And we're going to assume that that got realized in year 1, and the ending unamortized acquisition differential is 0. Patent, we know, had a 5-year useful life, and that was $70,000. So if you think about this, we're going to amortize the 70 over 5 years, and that's $14,000 per year. Now, we need to be mindful of the date of acquisition. The date happens to be January 1st, which means that we have a full year amortization in year 1. Some questions may have a June 1st acquisition date. If it's a June 1st acquisition date, then the first year amortization for the patent would be 7/12 of the 14, because from June 1st to December 31st is 7 months of the 12-month year. But in this case, the acquisition is on January 1st, and we know that $14,000 for 2 years is $28,000. Now, let me explain to you what's going on. The patent on the books would have been amortized $14,000 per year more than they should have, because the book value was overstated. And that's why we are deducting the $28,000, because the actual income is understated, the expense is overstated. So year 3, it's $14,000, and what we have is we have a remaining book value of unamortized patent of minus 28. Well, it's 5 years, so there's 2 years left, right? Goodwill is subject to impairment, and we talked about that before, and we're told specifically in the question that the goodwill impairment test was done in year 3, and they found that $19,300 was recorded as an impairment. So that would have been an expense, additional expense, that I needed to make sure that I accumulate and adjust the consolidated statement to reflect that. Now the value of goodwill is $330,000. So that means that the unamortized goodwill is $310,700. So if I add all this, I get my $300,000, which is my total AD. All right, this is my AD. Okay, so that's my total AD. So this ties, right? This number is basically this number. Okay, and then my year 1 and 2 amortization, I'm going to need to know this, and I'll tell you why you need to know this. You're going to need to know what adjustments you made on prior's income so that you can make the adjustment to the consolidated retained earnings. And that's essentially the purpose of this amortization schedule, is allowing you to then determine how do you adjust consolidated statement of retained earnings without having to accumulate those adjustments. We've done that through the acquisition table, amortization table. Okay, so that's the amortization schedule. Okay, so before we can answer the question, we needed to analyze the acquisition cost. That's exactly what we did here. And then we had to determine our acquisition differential based on 100% of the fair value less the book value at the date of acquisition. That's extremely important. And then we needed to analyze why we paid $300,000 more. Was it goodwill? Was it partly because of inventory and patent? And we did that. And now we're going to amortize, because all of these adjustments need to be adjusted to Small's income so that we can then determine what is the appropriate consolidated net income. Okay, so let's answer the question. The question says that Part A asks us to do a cost method journal entry. So the cost method, so Part A. So, cost method. Okay, so we know under the cost method, all we do is we pick up our share of dividends as dividend income, and we adjust the investment if there's a permanent impairment. So, we're going to debit investment in small and credit. I'm assuming we paid cash. 600,000. And this would be year one. Now, small reported dividends of 25,000 in the first year. So we're going to debit cash, credit dividend income. That's part of the income statement. And that would be 25,000 times 75% because we own 75%. That would be 18,750. It's also good to show your calculation right underneath the journal entry. I think it's important to show how you came up with 18,750. Now, the second year, they also declared another dividend, and this time they declared $10,000 according to the question. And that gives us the same entry, but this time it's $7,500 instead. And for year three, it's 40,000 times 75%. So we don't adjust the investment. Under the cost method, we don't adjust the investment. The only time we actually do that if there's a permanent decline in the value of the investment. And again, the question would kind of give you, I guess, sufficient case facts to determine whether the investment in small at $600,000 is overvalued, and it's going to be based on perhaps the decline in market price, the operating performance, the multiple years of losses that they've reported, and etc. So there's going to be a lot of information that allows us to perhaps reduce that investment. But there was nothing in this question. But nevertheless, that's what the cost method is. Okay? Now, Part B asks us to provide certain consolidated. So Part B is we're looking for, right, consolidated balance sheet items. Okay? Actually, it's also income statement items as well. So let's take a look at the first one. They asked us to calculate goodwill. And this is, by the way, at the end of year three. So, goodwill, what is that? Well, we just calculated that, didn't we? Wasn't it this number here, goodwill 310? Okay, so I'm going to label this A. You know what? Yeah, let me label that A in red. And that would be the amount of goodwill. And that's already calculated, right? So I'm going to put down the word A beside it. I'm going to put down C, schedule. How's that? Okay? Okay. Part B asked, or number 2 asked us to calculate non-controlling interest. Non-NCI, and this is the balance sheet. And this is at the end of December 31st, year 3, isn't it? Okay. So how do we do that? Well, we want to know what the shareholders' equity is for small at December 31st, year 3. This is one way to calculate NCI balance sheet. So, how do we know? So let's calculate what that is. Well, we know common shares did not change. It was still 400,000, right? That was a $400,000 common shares, isn't it? Okay. Now, what's the retained earnings at the December 31st, year 3? Well, what we're going to do is we're going to take the date of acquisition of 100,000 and we're going to just update. We're going to add and deduct all of the profits and dividends that they reported for the last 3 years. And that was given to us, wasn't it? So we're going to take the 100,000, which is our opening retained earnings. I'm going to add the $80,000 profit for the first year, subtract the dividends for the first year. So this is year one. Then we're going to subtract the loss of 35 and the dividends of 10. And this is year two. And then we're going to add $90,000 of profit minus the 40. That's year three. All that adds to 160. So it's just a matter of calculating the retained earnings. And the sum of these two, so let me put that $400,000 here, gives me $560,000. This is the net book value, the shareholders' equity of small. We're going to add to this the unamortized acquisition differential, right? So this is essentially the amount of acquisition differential that still remains to be unamortized. And that came from our schedule. So I'm going to label that B. And that was $282,700. I'm going to label that B. And I call that C schedule. And that gives me $842,700. Now, this represents 100% of small. Now, NCI owns 25% of that, so 25% of 842,700 gives me 210. So this is how we calculate NCI at a point in time. So there's going to be a question where you're going to be asked to calculate the non-controlling interest balance sheet item at any future date. And what you've got to figure out is what is the shareholders' equity. The fastest way of doing it is what is the shareholders' equity of the subsidiary, in this case small, at a future date. In this case, it's year three. And that's the shareholders' equity, 560. Now, we got to that by adding the profits and dividends. Some question, they may give you the December 31st, year three shareholders' equity. In this question, they didn't, but you can still figure that out by adding the profit less dividends for year 1, 2, and 3. Then you need to go to your amortization schedule for your acquisition differential, and you need to figure out, because you overpaid for the investment, so you got to think about this, right? You paid more than the book value. You've already recognized, so how much did you pay more? You paid $300,000 more. You've recognized part of the overpayment as an adjustment to net income, which were already been in the consolidated retained earnings. This is still to be adjusted. So you need to add the 282, which is the unamortized acquisition differential, to the shareholders' equity section of small to determine what is the fair value of 100% of small at the date of acquisition plus the amortization. Then multiply that by 25% to give you the non-controlling interest. This is the most easiest and fastest way to calculate that. Now, another way of doing it, obviously, is you would take a look at the non-controlling interest at the date of acquisition, right, which is, so another way of doing it is to calculate non-controlling interest, which is 25% of 800,000, plus you're going to take 25% of the acquisition differential that you just calculated for year 1, 2, and 3. Adjust that. Plus, you're going to take 25% of the changes in shareholders' equity for year 1, 2, and 3. If you did it that way, much longer way, you're going to get to the same answer, but why bother doing that when you can do this one a little bit easier? Okay? So this is what I recommend that you do. Okay, so we just answered that. Now we're asked to calculate the retained earnings at the beginning of the year. So at the beginning of the year is 1/1 year 3 or 12/31 year 2. Okay, so how do we do that? How do we calculate the retained earnings, the consolidated retained earnings at the beginning of the year? This is consolidated. So we always start with the parent. So first we need to determine large retained earning, which is the parent's retained earning as of this date. And that was given to us. That was given to us as $500,000. So let me put the word given. Okay. Then we're going to take Small's retained earnings, again, beginning of the year. And how do we determine that? Well, remember, we did that same calculation, right? We figured out the ending, so we're just going to take year 1 and year 2, essentially. So we're going to take the Small's retained earning, which is $100,000, plus the 80 minus the 25, this is year 1, minus 35 minus 10, which is year 2. And that gives me 100,000, 110,000. We're going to deduct retained earnings at acquisition date, because you got to remember, we only pick up our share of income from the date of acquisition. That's 100,000. So that's 10,000. Now, how much did we amortize? So remember, we amortize less amortization of acquisition differential, right? And that was 12,000, wasn't it? So let's label that C in red. So that's 12,000 is what we're going to deduct. So put that C schedule. And this gives us a minus 2,000. And we're going to take 75% of that, because we only own 75, to give me 1,500. And if I add that to my large retained earnings, I get 498,500. And this is the consolidated retained earnings beginning, right? So 1/1 year 3. Does that make sense? Okay. Now, the next is they asked us to calculate profit attributable to large shareholders. Profit attributable to large shareholders. Okay, so this is number 4. So how much did large make? This is for year 3, right? So consolidated net income, and this is for year 3. So large profit for year 3 was 200,000. Okay, 200,000. Now, remember, they use the cost method. So we need to deduct the dividend income earned from Small. And if you remember our journal entry had, remember these journal entries? it showed that year 3 we recorded dividend income, which would have affected the profit. So we're going to label this as D. And that D is going to be the adjustment we need to make. So now this is the profit for large, the parent company, without any subsidiary. Now, when we get to future chapters, and when you're watching the future videos, it's important to note that we're going to take the same structure, the same adjustment, the same format, but we're going to add and deduct some of the unrealized intercompany transactions. This is within the two companies. We completely eliminated that in this exercise, but we're going to actually come back to a similar question in future chapters, which allows us to then look at how do we augment, change the structure of the way we're solving consolidated net income with incorporating, let's say, inventory, intercompany transaction, land intercompany transactions, and so on. Okay? So that's going to be covered in other videos. Now, there's no other adjustment, so we're going to add to it Small's profit. And we're told in year 3 they made $90,000. Now, what else do we need to add to that? We need to adjust the profit by the acquisition differential. Do you remember this acquisition differential? That's what we need to adjust. So we're going to call that E. So that's what we're going to adjust. Because you remember, part of the reason why we're going to adjust the net income, if you think about it, you guys, the goodwill needed to be written off. So that's an expense. But the patent had an overvalued, so the amortization was overstated. So we're going to adjust that by $5,300. This is the adjust for the amortization of AD, and I labeled that as E, wasn't it? E, C schedule. And then we're going to take 75% of that to give us $63,525, and that gives us our consolidated net income of $233,525. Does that make sense? Now, next and final one is they want to know what the profit attributable to non-controlling interest. Well, we know what that is. Because by doing this calculation, by virtue of the fact that this number is the profit adjusted for small, this will now be at 25% should be the profit attributable to NCI. So this would have been your adjustment to the NCI. And that would be the NCI income statement. Okay? Does that make sense? Okay, so let's look at the next and final required. It's asking us to, now they're saying assume that large uses the equity method to record its investment. They want us to prepare journal entries to show year over year what the adjustments would be on large's book, assuming that they account for the investment under the equity method, which is the second method, and they want to know the investment, the value of the investment at the end of year 3. So there's a couple of points that I wanted to talk about. So in your lecture notes, you saw, and this is something that you've seen before. So you'll see that this is the investment in subsidiary, which in our case is small. We're going to debit the original costs. This is what we bought. So that's the first entry that we saw in part A to this question. And then you'll notice that we're going to add all of our income earned and dividends received. Sorry, that change in retained earnings should not include the original cost. I should put that here. So this is actually, let me write this down, original cost, and that should be, so this is the net change. That's the net change that's referred to here. Sorry for being a mess here, but that's the net change. So really what we're saying is we need to adjust the original cost with the year-to-date changes in retained earnings of the subsidiary. So that's what we did, right? We took the income and dividend, we took 75% in the analysis that we did, and then we need to also adjust the year-to-date amortization of the acquisition differential. And if you remember, that would have been these adjustments in our analysis, okay? Then this other adjustment is referring to here is your intercompany profit analysis, which we haven't done yet in this question, okay? So that's what's going to happen under the equity method of investment. You notice at the cost, it's only this, because we don't adjust for any of these at all unless there's an impairment test. So it's going to be the original cost. Now, remember, under the equity method, we also have the revenue. The revenue, you could see that we record our share of the sub's net income. We also record any amortization of the acquisition differential. And if you think about it, this is the opposite. This is the reverse of the other entry, right? The investment T account. And this other adjustment, again, refers to the intercompany transaction that we haven't dealt with yet until other chapters, okay? Now, in your lecture notes, I'll show you that the consolidated retained earnings is an important aspect, which actually is the opposite to this side, the investment. So the entry that we adjust the investment, the retained earnings will be the opposite. So we start with parents' retained earnings. We pick up our share of the changes in retained earnings. So this is what refers to, and that's essentially what this was, right? Income less dividends. On the investment side is what we're adjusting for this. Then we have our year-to-date amortization of the acquisition differential and any year-to-date other adjustment. Again, this relates to intercompany transactions, which we haven't looked at this point. That determines our consolidated balance sheet. Okay, so let's take a look at the question. So this is part C. And part C says, what if they use the equity method? What are our journal entries? Well, let's take a look. So starting with debit investment, that's going to be the same, credit cash, and that's year one, $600,000. Now, for year one, we're going to pick up our share of income, so debit investment, credit income, investment income. And this would be $80,000 times 75% for year one, and that would be $60,000. Now, we're also going to pick up our share of the dividends, so debit cash, credit, investment, because under the equity method, we're going to adjust the dividends received as an adjustment as a return on the investment, so it reduces the investment. And that would be $25,000 at 75%. But remember, we need to adjust the PPD, right? The purchase price discrepancy. So we're going to debit the investment income credit investment. And this is the PPD, the acquisition differential, amortization. Sometimes I refer to acquisition differential as purchase price discrepancy. Purchase price discrepancy is an old terminology. Acquisition differential is kind of what the words that's used in the handbook. And that one, how did we get that number? Well, remember our amortization schedule? Really important. Okay, so we know that it's only 40,000 less 14 in the first year, wasn't it? Because we're going to break out the year 1, year 2 separately. So this one is 40 less 14 to give us 26, and 26K at 75% gives us 19,500. Okay? So this is balance sheet. Let me just label that. This is income statement, balance sheet, income statement, balance sheet, balance sheet. Okay? Now, what do we do for year 2? Year 2, we don't have to adjustment for investment, but for this one, we're going to, instead of debiting, we're going to credit investment. So I'm going to put credit investment here. And this is the balance sheet. And I'm going to debit investment income. And this one, we know that this one had a loss, right? So it's 35,000 at 75%. This will give us a credit of 26,250, and this is 26,250. So let me just delineate this. It's starting to get a little bit messy. So let me do that. So this is okay, so there's 4 adjustments essentially. Okay, so this is definitely, and this is a debit to investment income, a credit to the balance sheet. And the dividends, how much dividends was declared? It was 10,000, wasn't it? Yeah, 10,000. At 75% was 7,500. Now, it's okay to declare a dividend in the year of a loss because the year-to-date earnings is greater than the amount of dividends that's been declared. Okay. Now, if I look at the acquisition differential adjustment, it would have been just the 14,000, right? Because remember, we broke it out. And this time it would be, again, we're going to change this up. We're going to debit, in this case, investment. Because remember, the patent was overvalued, wasn't it? And we're going to credit the investment income. So let me just put an arrow beside that because it seems a little confusing, isn't it? So it makes it so much clearer, isn't it? Okay. Now, for year 3, we've got $90,000 of profit at 75%, so that would be a debit of 67,500, and that would be a credit to investment income of 67,500. So debit investment credit investment income. And for the dividends, there was $40,000 of dividends declared at 75%. And again, let me just put an arrow beside those. And once again, it would be 30,000, right? And then there was this acquisition differential of 5,300. So if I look at my schedule, I can see that 5,300 is 39.75, but this one is debit investment, 39.75. Does that make sense? No, debit investment income. I apologize. Yeah, debit investment income, 39.75. And credit, the balance sheet, 39.75. So I hope that's clear on the screen, but that's essentially what that is. Okay? Now, let's answer the very last question. It asks us to determine the investment in small under the equity method. So all we need to do is add these journal entries, isn't it? Okay, so investment under, sorry, in this case it's under the, it's under the equity method. So investment under equity method. So we know that the cost is $600,000. That's how much we paid, right? We've got Smalls retained earnings at 12/31 year 3, and we know that was $160,000. And how did we get that number? 160 was a number that we calculated, wasn't it? Let me try to get my, it was this one. Remember when we calculated the NCI, we saw that it was 160 in part 2. That would have been the retained earnings of Small. Okay, we're going to subtract, deduct Small's retained earning at January 1st, year 1. This is the date of acquisition. And that's 100,000. Now we're going to subtract the AD amortization. And the year-to-date amortization is the sum of these two. Isn't this schedule really handy? You can start to see the power of the schedule because we have to pull numbers from the schedule to adjust the subs raw shareholders' equity to come up with a consolidated retained earnings or consolidated investment. You saw the both sides of that T account in my lecture notes. You'll see that's extremely important, and that's why the accuracy of this schedule is important. So year 1 and year 2, and year 3 was 5,300. The sum of those two would have been 17,300. And that's a negative adjustment. That's 42,700 multiplied by 75% to give us 32,025. And this is the investment in Small under the equity method. Okay? Thank you.